Hey there, curious minds. Welcome back to the Deep Dive, the show where we slice through complex topics, extract the most important nuggets of knowledge, and serve them up just for you.
Today, we're embarking on a crucial journey through the core of financial reporting. Think of it as gaining a unique lens to truly understand how companies tick from their daily operations to their long-term strategic health.
Exactly. Forget dense textbooks. We're going to navigate the essential financial statements, uncover some surprising facts, and show you exactly why this information matters for anyone looking to be truly well-informed.
Right.
You've given us some rich source material, and our mission today is to distill those crucial insights so you can feel completely confident navigating these foundational documents.
We'll break down each component, clarify the terminology, and use the concrete examples from your sources to illuminate every concept. By the end of this deep dive, you'll have a profound appreciation for the comprehensive financial story these statements tell.
Okay, let's dive in. So when we talk about financial reporting, we're really talking about a full set of financial statements. What exactly makes up this crucial collection, and what's its overall purpose in painting a picture of a company?
That's a great starting point
Yeah.
because these aren't just arcane documents for accountants. Under U.S. GAAP, or generally accepted accounting principles, general purpose financial reporting encompasses a full set of financial statements and their accompanying notes. They are the primary tools for understanding a company's financial health, its performance over time, and its ability to generate cash.
Kind of like the business's GPS.
Exactly, giving you coordinates on where a company stands and where it's been. So what are these crucial documents that form the Big Five? First, the Statement of Financial Position, more commonly known as the balance sheet. This statement is like a single snapshot in time. Imagine taking a picture of a company's financial standing at a very specific moment, say, at the close of business on December 31st. It tells you what the company owns, which are its assets, what it owes to others, which are its liabilities, and what's left over for the owners, which is stockholders' equity.
Assets, all liabilities, plus equity. The classic equation.
It strictly adheres to that fundamental accounting equation, yes. Assets, liabilities plus stockholders' equity.
So it's not a story over time, but a frozen moment. That's a key distinction. And I see a note about classified balance sheets. Does that classification system offer a different kind of insight, or is it just, a formatting choice?
That's a thoughtful question, and it's definitely more than just formatting. Entities typically present a classified balance sheet. This means they distinguish between current and non-current assets and liabilities.
Okay, short-term versus long-term stuff.
Right. Current items are those expected to be converted to cash, used up, or settled within 1 year or one operating cycle, whichever is longer. Non-current items are everything else, the long-term stuff like property or long-term debt. This classification is incredibly helpful for analyzing a company's short-term liquidity. Can it meet its immediate obligations? And its long-term solvency.
Makes sense.
While classified is common, a liquidity-based presentation, where items are simply listed from most liquid to least liquid, is also permissible, though less common.
Can you give us a quick overview of the common things we'd see on that balance sheet, given the illustrative content in our source material? Without getting bogged down in every single number, what are the key categories and what do they represent?
Absolutely. Looking at a typical balance sheet, like the company name balance sheet, as of December 31, year 1 in your materials, you'd find assets first. Under current assets, you'll see highly liquid items like cash and cash equivalents, short-term trading securities, and what customers owe you in accounts receivable.
Money coming in soon, hopefully.
Hopefully. You also have inventory goods ready for sale and prepaid expenses, which are payments made for future benefits, like prepaid insurance. Moving to non-current assets, these are the long-term investments. Investments could be things like available for sale securities or held to maturity securities. You'd also see stakes in other companies as investments in affiliates.
Right.
A major section here is property, plant, and equipment, which includes land, building, and equipment. Crucially, these are often shown net of accumulated depreciation.
Ah, depreciation. That's how the cost gets spread out, right?
Exactly. Depreciation is how companies systematically spread the cost of an asset over its useful life, so net tells you its remaining book value. Finally, intangible assets like goodwill, often from acquisitions and patents, net of their amortization, round out the long-term assets. These are assets you can't touch, but provide significant future economic benefit.
That's a really clear breakdown of what a company owns. What about the other side of the balance sheet, what it owes and what's left for the owners?
On the liabilities side, also typically separated into current and non-current. Under current liabilities, you'd find immediate obligations like the current portion of long-term debt, money owed to suppliers as accounts payable, short-term loans called notes payable, and accrued expenses like interest payable and salaries payable.
Things due pretty soon.
Correct. Unearned revenue is also a current liability, representing cash received for services not yet delivered. For long-term liabilities, we have bigger commitments like bonds payable, a significant form of borrowing. Deferred income tax liability represents future tax obligations, and pension and other post-retirement benefit liabilities are long-term obligations for employee benefits. The sum of these gives you the company's total debt. Below that, we arrive at stockholders' equity. This section details the owner's stake.
The owner's piece of the pie.
Exactly. You'll see capital stock, which includes preferred stock and common stock, typically showing par value and how many shares are authorized, issued, and outstanding. Paid-in capital, in excess of par, captures amounts shareholders paid above the stock's nominal value. Retained earnings are the accumulated profits the company's kept over time, not distributed as dividends. Accumulated other comprehensive income captures certain gains and losses that bypass the income statement. And finally, treasury stock, which is the company's own stock it has repurchased, shown as a reduction to total equity.
Wow.
The beauty of the balance sheet is that total liabilities and stockholders' equity should always precisely match total assets. It's a fundamental check.
Wow, that's quite the architectural blueprint just for the balance sheet. So that's the snapshot. What about the movie of a company's performance?
That brings us to the statement of earnings, universally known as the income statement. Unlike the balance sheet snapshot, the income statement tells the story of a company's financial performance over a period of time, typically a quarter or a full year. It's fundamentally about how much revenue the company earned and what expenses it incurred to generate that revenue, ultimately leading to its net income or loss.
So profitability over time.
Exactly. It's where you find the core operating results and the profitability narrative. The third of the big five is the statement of comprehensive income. This statement expands on net income, including all changes in equity from non-owner sources that aren't part of the regular net income calculation.
Okay, we'll get back to that one.
We'll dive into this more deeply later, yes. But for now, understand it's essential for the full picture of how a company's equity changed during a period, capturing certain unrealized gains or losses that traditional net income misses.
Then we have cash flows. So the income statement gives us profit, but profit isn't always cash. How does the statement of cash flows bridge that gap, and why is that distinction so vital for understanding a company's true liquidity?
That's an insightful question, and it highlights why the statement of cash flows is so vital. A company can be profitable on its income statement, but still struggle with cash flow, perhaps due to large accounts receivable or inventory buildup.
Right. Profit on paper doesn't pay the bills.
Precisely. This statement tracks the actual movement of cash in and out of the business, categorizing it into three critical activities: operating activities, cash from core business operations; investing activities, cash from buying or selling assets like property or investments; and financing activities, cash from debt or equity transactions like issuing stock or paying dividends. It offers a critical perspective on a company's ability to generate and manage the lifeblood of its operations.
Cash.
Okay.
Operating, investing, financing. Got it.
And finally, the fifth key statement is the statement of owner's equity, sometimes called the statement of stockholders' equity. This document details the changes in the owner's stake in the company over a period. It shows how retained earnings changed, how new stock was issued, or how treasury stock activity impacted the overall equity. It's a reconciliation of the beginning and ending balances of all equity accounts.
So these statements collectively paint a comprehensive picture. But what stands out to you as the biggest reason a learner needs to grasp these beyond just a surface-level understanding? Why is this so crucial for our listeners?
What's fascinating here is how these statements, particularly the income statement, are incredibly useful for determining a company's profitability, assessing its value for investment purposes, and evaluating its creditworthiness.
So for investors, lenders, even employees.
Absolutely. If you're thinking of investing in a company, lending money to it, or even just working for it, these documents provide the fundamental insights. This raises an important question. How does knowing a company's past performance help predict its future cash flows? It's not just about looking backward. The income statement, for instance, provides a strong basis for forecasting. Okay. By understanding the trends in revenues and expenses, you can make informed predictions about the amounts, timing, and uncertainty of those future cash flows. That's the power of these reports. They aren't just historical records, but powerful predictive tools.
Let's zoom in on the income statement. It sounds straightforward, revenue minus expenses equals profit, but there's a lot of specific terminology that can trip people up. Let's start with cost and unexpired costs. What's the fundamental idea behind these terms?
Absolutely. The core purpose of the income statement is to provide information about the uses of funds, that's expenses and losses, and the sources of funds, that's revenues and gains. Getting the terminology right is crucial for accurate interpretation. So let's do a terminology deep dive. First, cost. Simply put, it's an amount measured in money expended for items. This could be anything from capital assets like machinery to services like payroll for employees or merchandise that a company buys to resell.
Just what you paid.
It's what you actually paid for something.
Yeah.
Very straightforward. Now, here's where it gets really interesting. The distinction between unexpired costs and expired costs. Unexpired costs are essentially assets.
Okay.
They are costs that have been incurred but will provide an economic benefit in future periods. Think of them as stored value. They only become expired costs, which are what we call expenses, when that future benefit is consumed, used up, or systematically allocated to the current period.
So it's like converting an asset into an expense.
Precisely. It's the process of converting an asset into an expense as its economic benefit is utilized.
That's a great distinction. Can you give us some concrete examples to really solidify this idea of something starting as an unexpired cost and then becoming an expired cost?
Certainly. Let's look at a few common examples from your materials. Inventory. When a company purchases inventory, it's an unexpired cost, an asset sitting on the balance sheet ready to be sold.
Right.
Once that inventory is sold, its cost becomes cost of goods sold on the income statement, which is an expired cost during that period. Unexpired, prepaid, cost of insurance. When a company pays for a year of insurance up front, it's an unexpired cost, a prepaid asset.
Okay.
Over time, as each month passes, a portion of that prepaid amount expires and becomes insurance expense. The benefit of the insurance for that month has been consumed. Net book value of fixed assets. When a company buys a building or equipment, it's recorded as an asset at its cost. As it's used over its useful life, its value is systematically expensed through depreciation expense.
So wearing out, basically.
Kind of, yeah. The remaining book value is still an unexpired cost, but the portion recognized for the period is an expired cost. Unexpired cost of patents. Similar to fixed assets, when a company acquires a patent, it's an intangible asset, an unexpired cost. As the patent's legal or economic life is consumed, its cost is allocated as patent's expense through a process called amortization. To use a simple analogy, think of a bag of groceries. When you buy them and put them in your pantry, they are unexpired costs. They are assets, ready to provide future benefit.
Okay.
When you cook and eat those groceries, they become expired costs. You've consumed their benefit, and now they're an expense of your meal.
That analogy makes it super clear. So that's costs and expenses. What about the other side of the equation, revenues and gains? And how does the gross concept versus net concept play into this?
Another crucial distinction. When we talk about revenues and expenses, they are generally reported using the gross concept. This means they are reported at their full total amounts.
The whole amount.
The whole amount. For revenues, it's the full amount an entity expects in exchange for good or services transferred. For expenses, it's the full amount incurred. They are shown separately, in full detail, because they are part of the company's core operations. In contrast, gains and losses are reported using the net concept. This means they are reported at their net amounts, which is typically the proceeds from a transaction less the book value of the item sold.
So the difference.
The difference, exactly. This is a key distinction because gains and losses often arise from peripheral or incidental transactions. Let's break down gains and losses specifically. Gains. These often arise from activities outside the ordinary course of a company's regular business. For example, if a manufacturing company sells an old piece of equipment for more than its book value, that's a gain. It's not their primary business.
Or finding gold.
Or, as your source humorously puts it, finding gold on company property. A gain doesn't require an associated expense to generate it in the same way revenue does. Losses. These are cost expirations that are not in the ordinary course of business, or they occur without generating revenue. So if that same manufacturing company sells an investment for less than it paid for it, that's a loss on the sale of an investment asset.
Okay.
Or, if a company has an asset that becomes obsolete and they simply abandon it without any revenue generation, that's also a loss. An important disclosure rule here. Items that are unusual or infrequent, or both, should be reported separately as part of income from continuing operations. Their nature and financial statement effects should be clearly disclosed, either directly on the income statement or in the accompanying footnotes.
Why is that disclosure so important?
Well, this transparency helps users understand which items are one-off events versus part of the regular, repeatable business operations. It helps in forecasting future performance more accurately.
So we have these terms. How do they show up on the actual income statement? Are there different ways companies present this information? Because I've seen some statements that look really simple and others that are quite detailed.
Yes, exactly. There are indeed two primary presentation formats for income from continuing operations, both of which tell the same financial story, but with different levels of granularity. These are the multiple-step income statement and the single-step income statement.
Okay, multiple step and single step.
The multiple-step income statement is perhaps the more detailed and, for many analysts, the more informative. This format clearly separates operating revenues and expenses, those related to the company's core business activities, from non-operating revenues and expenses and other gains and losses.
So it breaks it down more.
Right. This structure allows users to see profitability at different stages.
What's the main benefit of this approach? Why go through the extra steps?
The biggest benefit is enhanced user information. It provides readily available data for ratio analysis and helps highlight key profitability stages. You can easily see gross margin, then income from operations, before you even consider non-operating items. It paints a more nuanced picture.
Okay.
Let's look at example 1, multiple-step income statement for Radon Industries, Inc., as outlined in your source for the year ended December 31, year 1. Instead of walking through every single line item of the calculation, let's look at the structure and what it reveals. Radon's multiple-step income statement starts with net sales, which combines all their various revenues like sales, service, and rentals, after accounting for things like returns and discounts.
Top line revenue.
Top line, exactly. From that, they subtract cost of sales, the direct cost of generating those revenues to arrive at their gross margin. This shows you how much profit they're making just from their core products or services. Next, they detail their operating expenses, breaking them down to selling expenses, general and administrative expenses, and depreciation.
The costs of running the main business.
Precisely. What stands out for Radon Industries is that after subtracting these operating expenses from their gross margin, they actually end up with an income loss from operations that's a small loss. This tells you their core business activities on their own weren't profitable in this period.
Ouch.
However, the story shifts when you look at other revenues and gains and other expenses and losses. Radon had significant interest revenue, gains from selling securities and other various revenues. They also had interest expense, a loss on the sale of fixed assets, and a notable restructuring expense.
Restructuring. That sounds like a one-off kind of thing.
It often is. And here, this restructuring expense, even though large, is classified as an infrequent event within continuing operations, not a strategic shift requiring discontinuation. Once all these non-operating items are factored in, Radon's income before income tax swung into the positive, leading to their income from continuing operations. Below that, for Radon Industries, we then see discontinued operations, net of tax, which is a loss.
We'll get to that one later, I assume.
We will. This is reported separately because it's a strategic shift, and it's shown net of its tax effect. The final figure is net income. The multiple-step format vividly illustrates how different layers of a company's financial activity contribute to the final profit or loss, letting you see operational health distinct from other income and expenses.
That's incredibly detailed. It's clear why that format is called multiple step. Now, what about the simpler one, the single step?
The other format is the single-step income statement. As its name suggests, it's much simpler. In this presentation of income from continuing operations, total expenses, including income tax, are simply subtracted from total revenues in one single step.
What's the appeal of that one? While it's simple, does that simplicity ever come at the cost of losing some key insights, perhaps for analysts trying to dissect operational efficiency?
That's precisely the trade-off. The primary benefit of a single-step income statement is its simple, straightforward design. It avoids implying any hierarchy of importance for different revenue or expense types, as everything is just grouped together. It's clean.
But maybe too clean.
To your point, yes, that simplicity can sometimes obscure the operational story. You don't immediately see the gross margin or operating income, which are critical for understanding core business profitability before other factors come into play. If we look at example 2, single-step income statement for Radon Industries, Inc., Again, with the same underlying facts, you'll see this clearly. It starts with a combined total for all revenues and other items.
Hmm.
Notice how sales revenue, service revenue, interest revenue, and even gains on security sales are all lumped together. It's just one big bucket of sources of funds.
Okay.
Then it lists all expenses and other items. Cost of goods sold, various operating expenses like selling and admin, interest expense, depreciation, even that restructuring expense and income tax expense. This is just one big bucket of uses of funds.
Just totals, basically.
Just totals.
Okay.
Finally, in one simple step, income from continuing operations is calculated by subtracting the total expenses from the total revenues. And just like with the multiple step, it ends with discontinued operations, net of tax, leading to a net income.
That makes sense. It's like different ways to tell the same story, just with different levels of detail and emphasis. The single step is definitely cleaner to look at, but the multiple step clearly gives you more analytical leverage for understanding the nuances of a company's operations.
Exactly right. Depends on what level of detail you need. Building on our income statement discussion, some significant events are reported separately to provide a clearer picture of a company's continuing operations versus what might be a one-time or strategic shift. This brings us to discontinued operations.
Okay, this is when a company gets rid of a big piece of itself.
Essentially, yes. This is where a company sells off or plans to sell off a significant part of its business. Discontinued operations are reported separately from continuing operations, and a critical point here is that they are reported net of tax.
Net of tax, so the tax impact is already included in that number.
That's correct. This means the income tax effect related to that discontinued part of the business is already factored into the reported amount. So you see the direct after-tax impact of the decision on the bottom line.
So what exactly qualifies as a discontinued operation? It can't just be selling off an old asset, right? It sounds like there's a higher bar.
Correct. There's absolutely a higher bar. For something to qualify, it must be a component of an entity. Think a division, a subsidiary, maybe even a group of assets that has been either disposed of or is classified as held for sale.
Okay.
But there's a key condition. The disposal must represent a strategic shift that has or will have a major effect on the entity's operations and financial results. This is what truly differentiates it from a routine sale of a piece of equipment.
A major strategic shift, like getting out of a whole line of business.
Exactly. Examples of such strategic shifts, as identified in your source, could include the disposal of a major geographical area where the company operates, the disposal of a major equity method investment, meaning a significant ownership stake in another company, or, as you said, the disposal of a major line of business. Your source provides a great illustration with AmServe, Inc., a food service company. Historically, their fast food restaurant segment was the largest in terms of revenue and operating profit.
Okay.
But with public demand shifting to healthier options, AmServe decided to sell its fast food operation and focus on selling to local restaurants, offering healthier fare. Even though the new focus would lead to lower revenue per unit, it would generate higher operating profit per unit.
Interesting strategic move.
Right, because the fast food division was their largest component by both revenue and operating profit. This disposal constitutes a major strategic shift, and thus it must be reported as a discontinued operation. It's not just a minor adjustment. It fundamentally changes the company's future direction.
That makes perfect sense. It's about the magnitude and the strategic intent. What specific items are included in the calculation of discontinued operations, and how do they show up on the income statement?
The calculation typically includes three types of items, all reported net of tax. One, the results of operations of the component itself, meaning the revenues and expenses from that division up until it was disposed of or classified as held for sale.
So its own little income statement for that period.
Oh, pretty much, yeah.
Oh.
Two, any gain or loss on the actual disposal of the component. Three, and crucially, an impairment loss, which is recognized if the carrying value of the component is greater than its fair value, less costs to sell.
An impairment loss, like writing down the value because it's not worth what's on the books anymore.
Exactly. There can also be subsequent increases in fair value, but these gains are limited and cannot exceed any previously recognized cumulative losses. An important practical note here. Once a component is classified as held for sale, its assets are no longer depreciated or amortized.
Why is that?
Well, because the company no longer expects to use them to generate future economic benefits through its continuing operations. The intent is to sell them, so depreciating them further doesn't align with that intent. For reporting, these amounts are included in discontinued operations in the period in which they occur. Also, if a component is classified as held for sale, its results for the current period and for all prior periods presented for comparison must be reclassified and shown as discontinued operations.
Ah, so you restate past results too for comparison.
Yes, exactly. This provides comparability for users. They are presented as a separate component below income from continuing operations net of tax. The gain or loss on disposal must be disclosed either on the income statement face or in the notes.
That's a truly comprehensive example. It highlights how much detail goes into making these statements truly informative. This sounds like it could get complicated fast. Can we quickly look at the all sports company example 3, to bring it all together without getting lost in the weeds of every calculation step? What's the key takeaway there?
Absolutely. The all sports company example is a great way to see how these complex parts fit together. The core facts are, all sports company's golf division is losing money, and they decide to dispose of it. Its carrying value is $4 million, but its fair value less cost to sell is $2.2 million.
Uh-oh, that sounds like an impairment loss coming.
You got it. A significant impairment loss right there. The division is later sold, also at a loss compared to that fair value. The crucial takeaway from the all sports example is that the loss from operations of the discontinued golf division, along with its impairment loss and eventual loss on sale, are calculated net of tax and then presented separately on the income statement, below income from continuing operations.
So it pulls all that negative impact out of the main continuing operations section.
Precisely. For year one, for example, the total after-tax impact of the golf division's operating loss and the impairment loss amounts to a substantial hit to income, but it's clearly labeled as discontinued. For year two, the continuing operating losses leading up to the sale, plus the actual loss on disposal, are similarly reported net of tax and separate. What this detailed breakdown truly reveals is how a seemingly small accounting decision to classify a divested business as discontinued can dramatically reshape the reported profitability, making a company appear much stronger in its core operations.
Ah, okay. So it cleans up the picture of the ongoing business.
It does. For you, the listener, this means looking past the top-line net income and asking, is this profit truly from their ongoing business or from a one-time strategic shift that won't recur? It ensures you're assessing the health of the business that's actually moving forward.
That's a powerful distinction. It clarifies how much detail goes into making these statements truly informative. Speaking of global business, what about foreign currency transactions? How do companies deal with the complexities of operating across borders and in different currencies?
Ah, yes, the joys of global commerce. This raises an important question. How do companies deal with transactions in different currencies? And what happens when exchange rates change?
Fluctuations can really bite, I imagine.
They certainly can. When a company buys or sells from a foreign company and agrees to pay or accept payment in a foreign currency, they face foreign currency transaction gains and losses. This occurs because the value of the currency can fluctuate between the time the transaction is agreed upon and when it's actually paid. Let's quickly define some foreign currency terminology. Exchange rate. This is simply the price of one unit of a currency expressed in units of another. We often see the direct method, like €1 equals $1.47, stating the domestic price of foreign currency. Current exchange rate, spot rate. This is the rate for immediate delivery of currency. A transaction is denominated or fixed in a currency when that's the currency used to negotiate and settle it.
Okay.
A foreign exchange transaction gain or loss will result if the exchange rate changes between the contract date and the payment date. This is the core risk companies face with international transactions. And here's another critical point. If a transaction is not settled at the balance sheet date, any unrealized gains or losses must be recognized in current net income.
Unrealized, meaning the transaction isn't finished yet.
Correct. This ensures that the financial statements reflect the current economic reality of those unsettled foreign currency positions as of the reporting date. The assets or liabilities are initially recorded at the exchange rate in effect on the transaction date, then adjusted at balance sheet date.
That's a lot of theory. Can we quickly look at the Alinto Company example 4, to see how these journal entries play out in real life, focusing on the core movements?
Absolutely. The Alinto Company example perfectly illustrates the accounting for foreign currency transactions. Facts. Alinto purchased goods for 100,000 pesos on December 1st, year one, when the rate was $0.10 per peso. By the balance sheet date, December 31, year one, the peso weakened to $0.08. Then, on February 1st, year two, when they paid, the peso had strengthened a bit to $0.99.
Okay, peso got cheaper, then a bit more expensive again.
Exactly. The key movements are, initially, Alinto records a $10,000 liability, 100,000 pesos straightforward, at year end. Because the peso weakened to $0.08, Alinto's dollar liability decreased by 2,000 pence, 100,000 pesos duly in 2 cents.
So that's good for them, right? The debt is cheaper in dollars.
It is. This is an unrealized gain of $2,000 recognized in net income for year one. The liability on their books is now adjusted down to $8,000 at payment. When Olento finally pays the 100,000 pesos in year two, it costs them $9,000, 100,000 pesos, $0 and dimes. Since their last recorded liability was $8,000, paying $9,000 means they incurred a $1,000 realized loss in year two.
Fascinating. So a company could have an unrealized gain in one year and then a realized loss on the same transaction in the next, depending on the currency fluctuations. It really emphasizes the volatility in international business and how it can impact reported profits.
Absolutely. It's a constant risk management challenge for multinational companies.
So far, we've dissected the income statement and looked at some unique items, but then we heard about comprehensive income. How does that fit in? Is it just net income plus some other stuff?
It's a bit more structured than some other stuff. It's a critical piece of the financial puzzle that gives you the full change in equity from non-owner sources during a period.
Okay, the full change in equity.
Right. While net income is indeed a crucial part of it, comprehensive income captures all changes in equity that aren't a direct result of investments by owners or distributions to owners. It's a broader measure of a company's financial performance than just net income alone. The formula for comprehensive income is quite simple at a high level. Net income plus other comprehensive income, comprehensive income.
Net income plus OCI equals comprehensive income. Got it.
We already know net income includes two main components: income from continuing operations and discontinued operations. We've covered those. Now let's talk about other comprehensive income, OCI. These are revenues, expenses, gains, and losses that are included in comprehensive income but are specifically excluded from net income under U.S. GAAP.
Okay, why exclude them from net income if they affect equity? Seems counterintuitive.
That's a fair question. The rationale is because they are generally items that haven't been realized yet, meaning they haven't been finalized through a transaction, or they are subject to significant volatility that might distort the regular income statement if immediately recognized there.
Ah, so it smooths out the regular income number a bit.
Exactly. Their inclusion in OCI prevents short-term fluctuations from excessively impacting reported net income, while still showing their effect on overall equity. It gives a more complete picture without making net income too jumpy.
So what are some of these other comprehensive income items that bypass the traditional net income calculation? Give us the big ones.
Your source highlights several key OCI items. Pension adjustments. These involve certain gains and losses from defined benefit pension plans that arise from actuarial changes or market performance of pension assets. Can be quite volatile. Unrealized gains and losses. This is a big one. It includes unrealized holding gains and losses on available-for-sale debt securities.
Available for sale. So investments they might sell but haven't yet.
Correct. These are investments that a company holds but doesn't necessarily plan to sell immediately or hold to maturity. Their fair value can fluctuate, and those fluctuations, gains or losses, go to OCI until the securities are actually sold. Foreign currency items. This includes translation adjustments for the financial statements of foreign entities, which arise when converting a foreign subsidiary's financial statements into the parent company's reporting currency. Also includes certain hedging transactions. Instrument-specific credit risk. For certain liabilities where a company chooses to report them at fair value, any changes in that fair value that are specifically attributable to the company's own credit risk are included here. A crucial concept related to OCI is reclassification adjustments.
Reclassification.
Yeah.
Moving things around.
Yes. These adjustments are necessary to prevent double counting. When an OCI item is finally realized, for example, when an available-for-sale security is sold, that gain or loss then moves from accumulated other comprehensive income to the income statement at a realized gain or loss.
Ah, so it graduates from OCI to net income.
Exactly. The reclassification adjustment effectively backs it out of OCI in that period to prevent it from being counted twice, once when unrealized in OCI and again when realized in net income. All these OCI items, both current period and from prior periods, accumulate in a balance sheet account called Accumulated Other Comprehensive Income, AOCI.
Okay, so AOCI is the running total on the balance sheet.
Precisely. It's a
Yeah.
component of equity. It's like a running total of all OCI from the current and all prior periods.
So if net income closes to retained earnings, OCI closes to AOCI. That's a great passkey insight. It keeps things neat.
Exactly. At the end of each accounting period, all components of comprehensive income are indeed closed to the balance sheet. Net income is closed to retained earnings, and other comprehensive income is closed to accumulated other comprehensive income. This is why AOCI is presented as a separate component of equity on the balance sheet. In terms of financial statement reporting of comprehensive income, it must be presented with the same prominence as other financial statements. It's not reported on a per-share basis, unlike net income, which is used to calculate EPS.
Why not per share?
Generally, because the items in OCI are often considered less indicative of core operating performance and can be quite volatile, regulators decided a per-share measure wasn't appropriate or potentially misleading. Under U.S. GAAP, there are two common approaches to presenting comprehensive income. One, the single statement approach. Here, OCI items are displayed individually and totaled below net income within a single continuous statement of comprehensive income. Two, the two-statement approach. This involves presenting a traditional income statement, which is then immediately followed by a separate statement of comprehensive income that starts with net income and then adds or subtracts the OCI items.
Let's quickly glance at the Sydney Technologies, Inc. Example 5 to illustrate these two approaches. What's the core takeaway about how they present the full picture?
Perfect. For Sydney Technologies, Inc., let's assume they have a net income of $1,200,000 for the year. Beyond that, they had some OCI items like unrealized holding gains and losses on available-for-sale securities and foreign currency translation gains and losses. After netting those out and factoring in their 25% tax rate, their net other comprehensive income for the period comes out to a positive $157,500. The key is that both the single statement and two-statement approaches will arrive at the same total comprehensive income, which for Sydney Technologies is net income, $12,200,000, plus other comprehensive income, $157,500, totaling $1,357,500.
Same final number, just looks different on the page?
Exactly. The single statement simply shows it all on one page, while the two-statement approach has a separate statement that starts with net income from the prior statement. It's purely a presentation choice. The final number is the same. This allows you to see the company's profit beyond just its core operations, capturing other swings in value. Furthermore, regardless of the format, required disclosures include the tax effects of each OCI component, changes in the accumulated balances of each AOCI component, and the total AOCI balance on the balance sheet. And remember, reclassification adjustments must be disclosed separately to avoid double-counting items that moved from OCI to net income.
So comprehensive income gives us a complete picture of a company's financial movements, even those not yet fully realized. It's like seeing the full iceberg, not just the tip. Where do companies actually publish all this incredible information for the public to see? Because if you're a prospective investor or just someone doing research, you need to know where to find these detailed reports.
This is precisely where the Securities and Exchange Commission, or SEC, comes in. For public companies, the SEC mandates stringent reporting requirements to ensure transparency and provide essential information to investors.
The SEC, keeping things transparent.
Hopefully.
Yeah.
Companies file these electronically through the ADGR system, electronic data gathering, analysis, and retrieval, making them publicly and readily available online. It's truly empowering to know this data is accessible to anyone. The primary annual report is Form 10-K.
The big one.
The big one, yes. Purpose. This is the detailed annual report for U.S. registered companies. It provides comprehensive insights into the business, identifies relevant risk factors, presents financial and operating results for the year, and offers management's perspective. It's the annual deep dive into a company's performance and strategy. Filing deadlines. These depend on the company's size, ranging from 60 to 90 days after their fiscal year end for large accelerated filers, $700 or plus market value, to other registrants.
So bigger companies have less time.
Right. The market expects information faster from them. Key items. The 10-K is packed with critical sections: management's discussion and analysis, MD&A. This is management's own narrative. It's their chance to explain the company's business results, financial condition, liquidity, capital resources, trends, risks, and critical accounting estimates.
So management's perspective, in their own words.
Exactly. It's often where you find insights into their strategic thinking straight from the horse's mouth. Though naturally read with a critical eye, quantitative and qualitative disclosures about market risk. This section details potential losses from changes in interest rates, exchange rates, commodity prices, etc., helping you gauge a company's exposure to market volatility. Financial statements and supplementary data. This is where you find the audited GAAP financial statements. Balance sheets for the two most recent years. Income statements, comprehensive income, cash flows, and changes in equity for the three most recent fiscal years.
3 years for the income statement, 2 for the balance sheet.
Correct. That's the standard requirement for comparison. It also includes the auditor's report, their independent opinion on the financial statements, and crucial certifications from the CEO and CFO regarding the accuracy and completeness of the 10K, a direct result of Sarbanes-Oxley Act requirements to hold executives accountable.
So that's the annual big picture. What about the quarterly updates? Are those as detailed?
For quarterly updates, public companies file Form 10Q Purpose. This provides a quarterly overview for the first 3 quarters of the fiscal year. It's similar to the 10K, but offers a more frequent snapshot. Filing deadlines, typically 40 or 45 days after the quarter end. Faster turnaround. Key items. The financial statements in a 10Q are generally unaudited, unlike the 10K, and may be condensed.
Unaudited, so less rigorously checked.
They undergo a review by auditors, which is less extensive than a full audit, but they aren't audited in the same way the annual statements are. They cover specific interim periods for comparison. The most recent quarter, year-to-date, and corresponding prior periods. The MD&A and market risk disclosures are also updated, focusing on changes from the previous period.
And what if something major happens between these regular filings, like a big merger or a sudden crisis?
That's when a company files Form 8K, known as the current report. Purpose. This form is filed for material events that occur between the regular 10K and 10Q filings, providing timely disclosure of significant happenings that shareholders need to know quickly.
Material events, like big news.
Big news, exactly. Common triggers include bankruptcy, major acquisitions or dispositions of assets, changes in the public accounting firm, or changes in directors or officers. Significant stuff. Filing deadline. Companies generally have a tight window of 4 business days to file an 8K after a triggering event. This ensures rapid dissemination of market-moving news, allowing investors to react quickly.
4 business days. That's fast. So you can essentially get a full financial health check on any public company just by knowing where to look. That's truly empowering for anyone trying to understand the financial world.
It really is. EGIR is your friend. With a solid understanding of the primary financial statements, let's shift our focus to the owner's claim section. Stockholders' equity. This is where the story of who owns what and how that ownership changes truly unfolds.
Right, the bottom section of the balance sheet.
Exactly. Stockholders' equity, also called shareholders' equity or owner's equity, represents the owner's claim to the net assets of a corporation. Net assets are simply assets minus liabilities. On the balance sheet, it's typically the very last major section, following all the liabilities. It's crucial because it shows the accumulated financial results attributable to the owners, not just from operations, but also from direct capital infusions. A key detail is that this section must be clearly classified by source. You saw an example in your source, the Capital Core example layout, showing classifications like capital stock, additional paid-in capital, retained earnings, accumulated other comprehensive income, and treasury stock. Each of these tells a different part of the equity story.
Let's start with the foundational elements of equity, the different types of stock. What's the concept of legal capital, and how does it relate to something like par value? That always seems a bit abstract.
It can feel abstract, but it has a purpose. We begin with capital stock, which is often referred to as legal capital. This is the minimum amount of capital that, by law, must be retained by the corporation for the protection of creditors.
Ah, so it's a creditor protection thing.
Primarily, yes. It ensures that there's a baseline level of owner investment that can't be simply paid out without legal consequences, leaving creditors high and dry. This legal capital is typically represented by the par or stated value of common and preferred stock. When it comes to par value, preferred stock usually has one, which is a nominal value assigned per share in the corporate charter. Common stock may or may not have a par value. It's become less common over time. Any amount of cash or other assets received above that par or stated value goes into another equity account called additional paid-in capital.
Okay, so par value is the minimum floor. Additional paid-in capital is the extra paid above that floor.
You got it. This differentiates the legal capital, the minimum commitment, from the actual, often much larger amount shareholders contributed. We also need to understand the distinction between authorized, issued, and outstanding shares. Authorized shares are the maximum number of shares a company is legally permitted to issue according to its corporate charter. It's the upper limit.
Set in the company's rule book.
Right. Issued shares are those shares that have actually been sold or given to shareholders. This is a subset of authorized shares. Outstanding shares are the shares currently held by shareholders. This is the crucial number for things like calculating earnings per share and dividends. It's calculated as issued shares minus any treasury stock, shares the company has bought back from the market.
Okay, issued minus treasury stock outstanding.
Correct. The number of authorized, issued, and outstanding shares for each class of stock must always be disclosed in the financial statements.
So if a company buys back its own stock, those shares are issued but no longer outstanding.
Got it. Now, about common stock, what are its core characteristics? It sounds like the most straightforward type. Common stock represents the basic ownership interest in a corporation. Common shareholders are the true residual claimants. They bear the ultimate risk of loss, but also receive the ultimate benefits of the company's success.
High risk, high reward potential.
Potentially, yes. However, unlike preferred shareholders, they are not guaranteed dividends or assets upon liquidation. Their influence typically comes from their voting rights, which generally allow them to control management. They also have the right to share in the earnings of the corporation and, upon liquidation, to share in the assets after all creditors and preferred shareholders have been satisfied.
Last in line for assets if things go bad.
Last in line, but also have the most upside potential if things go well. Common shareholders may also have preemptive rights if granted in the Articles of Incorporation. This allows them to maintain their proportionate ownership in the company if new common stock is issued by giving them the first right to purchase a pro rata share of the new issuance.
Helps prevent dilution of their ownership percentage.
Exactly. A key metric for common shareholders is book value per common share. This measures the amount that common shareholders would theoretically receive for each share if all assets were sold at their book carrying values and all creditors were paid off.
Sort of a liquidation value based on the books.
Kind of, yes. It's a theoretical measure, as assets rarely sell for exact book value. The formula is common shareholders' equity, common shares outstanding. To calculate common stockholders' equity, you take the total shareholders' equity and subtract preferred stock outstanding at the greater of its call price or par value. Any cumulative preferred dividends in arrears. This deduction ensures you're only attributing equity to common shareholders after all preferred claims are considered.
So common stock is the bedrock. What about preferred stock? It seems to have more features and preferences.
Yes, preferred stock is an equity security with various preferences and features that common stock typically lacks. These preferences usually relate to dividends and liquidation. Preferred stock usually does not have voting rights.
So they get preference for payouts, but usually no say in running the company.
That's the typical trade-off. Let's unpack its key features. Cumulative versus non-cumulative. Cumulative preferred stock means that if a dividend is not paid in any given year, it accumulates and must be paid in the future before any dividends can be paid to common shareholders. These unpaid accumulated dividends are called dividends in arrears.
So the company owes them those past dividends.
They do before common gets anything. Importantly, dividends in arrears are not a legal liability until declared, but they must be disclosed to inform users of the outstanding claim. Non-cumulative preferred stock means dividends not paid in any year do not accumulate. The preferred shareholders simply lose the right to receive those undeclared dividends. Poof, gone.
Ouch. Cumulative seems much better for the shareholder.
Generally, yes. Participating versus non-participating. Participating preferred stock allows preferred shareholders to share with common shareholders in dividends that exceed a specific amount. This participation can be full, meaning they participate without limit, or partial, meaning they participate up to a certain percentage or amount.
So they get their regular dividend, PLUS, potentially more.
Correct. Generally, preferred shareholders get their preference dividend first, and then any additional dividends are shared between common and preferred based on the participation feature. Non-participating preferred stock means preferred shareholders are limited strictly to the dividends provided by their preference. They do not share in any excess dividends declared. Liquidation preference. Preferred stock often have a priority claim on assets during liquidation, getting paid back before common stockholders. If this liquidation preference is significantly greater than the stock's par or stated value, this fact must be disclosed in the equity section of the balance sheet, not just in the notes.
Specific placement requirement there.
Yes, a specific gap requirement to ensure prominence. Convertible. Convertible preferred stock gives the shareholder the option to exchange their preferred shares for common stock at a specified conversion rate.
Best of both worlds, maybe? Preference now, potential common stock upside later?
That's the appeal. It allows preferred shareholders to participate in the upside of common stock if the company performs well. Callable. Redeemable. Callable preferred stock can be repurchased by the company at a specified price. This gives the company flexibility to reduce its dividend burden or adjust its capital structure. The aggregate or per-share callable amount must be disclosed. Mandatorily redeemable preferred stock. This is a fantastic aha moment. Unlike other preferred stock, which is classified as equity, mandatorily redeemable preferred stock must be classified as a liability.
Whoa, hold on. It's called preferred stock, but it's treated as debt. Why?
Because it has a maturity date or other mandatory redemption feature, that means the company must buy it back at some point. It behaves much like debt in that regard. It has to be repaid. Therefore, it's classified as a liability, unless the redemption is required only upon liquidation of the entity.
That's a huge distinction. It could really change how leveraged a company looks.
Absolutely. It's a critical distinction that can significantly alter a company's reported debt levels, despite being called preferred stock. Always check the details.
That distinction with mandatorily redeemable preferred stock is really important. It shows why the name isn't always the full story. Can you walk us through the Samuel Co. example for calculating those dividends in detail, especially the fully participating aspect? It's often counterintuitive how that sharing works.
Absolutely. The Samuel Co. example 1, for dividend distribution on fully participating 8% cumulative preferred stock, is a perfect illustration of how these features interact. It can seem complex, but it follows specific rules. Facts. Samuel Co. has common and preferred stock. The preferred stock is cumulative, meaning past unpaid dividends accumulate, and fully participating, meaning they share proportionally with common stock in extra dividends after initial payments. In year 1, no dividends were paid. In year 2, $101,000 cash dividends were declared.
Okay, so there are dividends in arrears from year 1.
Correct. That's the first claim. Here's the critical process. First, the preferred shareholders get their accumulated dividends from year 1, the arrears, and their current year's preferred dividend, year 2. This initial allocation is their priority based on the cumulative feature. 2. Then, the common shareholders receive an initial dividend equal to the preferred's percentage, 8% in this case, based on their own total par value. This ensures equal treatment before participation kicks in.
So preferred gets paid first, past and present, then common gets its matching 8%.
Exactly. 3. Any remaining dividend amount after those initial payouts is then prorated between the preferred and common shareholders based on their respective total par values. This is the fully participating aspect. In action, they share proportionally in the remainder based on their total capital contribution at par.
So the leftover cash gets split based on the total par value of each class of stock.
Precisely. The calculation shows exactly how much goes to preferred, arrears plus current plus participation share, and how much to common, an initial 8% plus participation share. This intricate calculation isn't just about the numbers. It's a window into how complex preferred stock features can redistribute wealth between shareholder classes. Understanding this is vital for you, the investor, to accurately assess your potential returns and risks, particularly when companies are distributing capital. It shows that preferred stock isn't always a simple fixed payment.
That example really brings the participating aspect to life. It's complex, but vital for anyone assessing equity. So beyond the initial stock issuance, what other types of contributed capital are there, often called additional paid-in capital? Where does that come from?
That's additional paid-in capital, or APIC. This account essentially captures any contributed capital that is in excess of the par or stated value of the stock. It's not just about the initial sale of stock, though that's a major source.
So it's a bucket for various capital contributions beyond par value.
Exactly. It can arise from many other types of transactions. While it can come from various sources, it's often aggregated and shown as one single amount on the balance sheet for simplicity. Examples of how this account can increase or decrease include selling treasury stock at a gain. If a company buys back its own shares and later reissues them for more than it paid, that gain isn't recognized in net income, but rather increases additional paid-in capital, liquidating dividends. These reduce paid-in capital when dividends exceed retained earnings. Conversion of bonds or preferred stock into common stock, where the value transferred exceeds the par of the new common shares. Issuance of small stock dividends, which we'll discuss later. It's a broad category for non-retained earnings contributed capital.
And then retained earnings, this is where the profits live, right? The accumulated earnings.
Yeah. Exactly. Retained earnings are the accumulated earnings, or losses, if it's a deficit, that a company has kept over its lifetime, rather than paying them out as dividends. It's the cumulative net income less cumulative dividends since the company started. It does not include treasury stock or accumulated other comprehensive income.
So net income flows into retained earnings each year, and dividends flow out.
That's the basic flow. If it has a negative balance, it's called a deficit. The formula for retained earnings is simple at its core. It's your beginning retained earnings plus net income loss dividends declared, plus or minus any prior period adjustments or retrospective accounting changes. That gives you your ending retained earnings. Companies can also have appropriations of retained earnings. This means a portion of retained earnings is restricted or reserved.
Restricted, does that mean the cash is set aside?
No, that's a common misconception. It's not setting aside cash. It's merely a disclosure to shareholders that a portion of retained earnings is not available for dividends due to legal requirements, like a bond indenture, contractual agreements, or management's discretionary decisions for specific contingency purposes, e.g. setting aside for future plan expansion.
So it's just labeling part of the retained earnings as hands-off for dividends.
Precisely. An important rule here. An appropriation of retained earnings cannot be used to absorb costs or losses, nor can it be transferred to income. It's purely a reclassification within equity to signal intent or obligation.
We also heard about accumulated other comprehensive income, AOCI. Since it's accumulated, it feels like it belongs with retained earnings, but it's separate. Why the separation again?
Good question to revisit. AOCI truly is separate because its components like those pension adjustments, unrealized gains losses on available for sale securities, and foreign currency translation adjustments are not included in determining net income. Remember, they bypass the income statement.
Right, because they're unrealized or volatile.
Exactly. They are recognized in the period they occur and, as we discussed, combine with net income to form comprehensive income. Because they bypass net income, they don't flow through retained earnings. Instead, AOCI serves as their own distinct cumulative account within stockholders' equity on the balance sheet. It gives transparency to certain gains and losses that affect a company's overall value, but are considered too volatile or unrealized to hit the income statement directly.
Okay, that makes sense. Retained earnings for realized stuff, AOCI for the unrealized stuff. Now, a company can buy back its own shares, right? What happens then? That's what's called treasury stock, correct?
Yes, that's treasury stock. It's a corporation's own stock that has been previously issued to shareholders and subsequently reacquired by the company, but not formally retired. It's held in the treasury.
Why would a company do that, buy its own stock back?
Oh, several reasons. Maybe management thinks the stock is undervalued, or they want to return cash to shareholders indirectly, boost earnings per share by reducing the share count, or have shares available for employee stock option plans. When a company holds its own stock as treasury stock, those shares have no ownership rights. Treasury stockholders, meaning the company itself, do not have voting rights, nor do they receive dividends.
Can't vote or pay yourself dividends. Makes sense.
Right. Furthermore, a portion of retained earnings equal to the cost of the treasury stock may be restricted from being used for dividends, depending on state law, similar to an appropriation. There are two main accounting methods for treasury stock. The cost method, used by about 95% of entities, and the legal or par stated value method.
Cost method is the main one then.
By far. The primary difference is the timing of how gains or losses on treasury stock transactions are recognized. And here's a critical point for both methods. These gains and losses are always recorded as a direct adjustment to stockholders' equity and are not included in the determination of net income.
Ah, so buying and selling your own stock doesn't hit the income statement profit.
Correct. Net income or retained earnings will never be increased through treasury stock transactions. Gains go to additional paid-in capital. Losses reduce APIC or retained earnings. Also, under both methods, shares held as treasury stock are not considered to be outstanding shares.
Let's quickly touch on the cost method since it's so prevalent. How does it work for repurchases and reissues?
Under the cost method, treasury shares are simply recorded and carried at their reacquisition cost. A gain or loss, in an equity sense, is determined only when the treasury stock is reissued or retired.
So you track the cost you paid to buy them back.
Exactly. The journal entries are straightforward. When shares are repurchased, treasury stock is debited. It's a contra equity account, reducing total equity, and cash is credited for the reacquisition cost. When they are reissued, cash is debited for what you receive, treasury stock is credited for the original cost you paid, and any difference between the reissue price and the reacquisition cost is adjusted through additional paid-in capital treasury stock.
What if you reissue them for less than you paid? A loss.
If you reissue below cost, you first reduce any existing additional paid-in capital from previous treasury stock gains. If that's not enough to cover the loss, then retained earnings takes the hit. The key is, no matter what, treasury stock transactions never increase reported net income or retained earnings directly. The key takeaway from the balance sheet comparison of the two methods, as shown in your source, is that while the presentation of the equity accounts differs, the total stockholders' equity is the same under both methods. This means the ultimate impact on the company's financial position is identical, just the internal breakdown of equity accounts differs.
Same total equity, just different labels inside the section.
Pretty much. We also have retirement of treasury stock. If acquired with intent to retire them, it's a permanent removal. And donated stock, a company's own stock received as a donation, causes no change in total equity, but shares outstanding decrease, increasing book value per share, recorded at fair market value.
So much detail just in treasury stock. What about other ways stock gets issued, or how dividends are distributed beyond just cash? Seems like there's more to equity transactions.
Let's continue with stock issuance and other forms of distributions, as there are quite a few variations. When it comes to accounting for a stock issuance to non-employees, the entries depend on whether the stock is issued above, at, or below par value.
Usually above par, right?
Most often, yes. Stock is issued above par, meaning the cash received is debited, and the capital stock, for par value, and additional paid-in capital accounts, for the excess, are credited. This reflects the legal capital and the extra amount contributed by shareholders. A common way for shares to be sold on credit is through stock subscriptions. This is a contractual agreement to sell shares with payment to be made later.
Like an installment plan for stock?
Kind of. Importantly, until the full payment is received, the shares are not officially issued, and any unpaid portions at year-end, subscriptions receivable, are shown as a reduction within equity, not as an asset. Another interesting item is stock rights. These provide existing shareholders with the opportunity to buy additional shares, usually at a price below the stock's current market price, maintaining their proportional ownership. The initial issuance of stock rights only requires a memorandum entry. No formal journal entry is made until the rights are exercised. Finally, other stock valuation issues. If stock is issued for services instead of cash, it's recorded at the fair value of the stock given up. If stock is part of a basket sale with other securities like bonds, the proceeds are allocated based on the relative fair market values of all the securities sold together.
That covers stock issuance. What about when companies give things back to shareholders? Distributions to shareholders' dividends go beyond just cash, right? You mentioned property dividends earlier.
Yes, exactly. A dividend is fundamentally a proportional distribution by a corporation to its shareholders, usually out of earnings. While cash dividends are the most common, there are several other types. First, the terminology around dividend dates is important. The date of declaration is when the board approves the dividend and a liability, dividends payable, is created, debiting retained earnings. The date of record determines which shareholders are eligible to receive the dividend, no journal entry. And the date of payment is when the cash is actually disbursed. Dividends payable, credit cash.
Declaration, record, payment. Okay.
Now, diving into the types of dividends. Cash dividends, most common distributing actual cash. Paid from retained earnings, only on outstanding shares. Treasury stock does not receive dividends. Property, in-kind dividends. These distribute non-cash assets like inventory or investments. On the declaration date, the property must be restated to fair value, and any resulting gain or loss on that restatement is recognized in income before recording the dividend. Then the dividend liability and retained earnings debit are recorded at that fair value.
So you recognize gain-loss on the asset before distributing it. Interesting.
Yes, it ensures the distribution is recorded at its current worth. Scrip dividends. These are essentially a special form of notes payable, committing to pay a dividend at a later date. Used when cash is short currently. Retained earnings is debited, notes payable credited, may bear interest. Liquidating dividends. These are very significant. They occur when dividends to shareholders exceed retained earnings.
Paying out more than the accumulated profit.
Exactly. In such cases, the portion of the dividend that is in excess of retained earnings is considered a return of capital. It's charged first to additional paid-in capital, and then, if that's not enough, to common or preferred stock, par value. This effectively reduces the total paid-in capital, signaling that the company is returning original investment capital, not just accumulated profits. Huge red flag, usually. Stock dividends. These distribute additional shares of a company's own stock to its shareholders instead of cash. The accounting depends on the size.
Small versus large. What's the difference?
Small stock dividend, 20–25% increase in outstanding shares. If it's a small dividend, it's assumed not to significantly affect the market price per share. Therefore, the fair market value of the dividend shares is transferred from retained earnings to capital stock, par value, and additional paid-in capital, the excess. There's no effect on total equity. It's merely a reclassification within equity. Large stock dividend, 20 to 25% increase. If it's a large dividend, it's expected to materially reduce the market price per share, much like a stock split. So only the par, or stated value of the stock dividend, is transferred from retained earnings to capital stock. No impact on APEC. Generally, stock dividends are not distributed on treasury stock, as it's not outstanding. Closely related to large stock dividends are stock splits. A stock split occurs when a corporation issues additional shares of its own stock to current shareholders, for example 2-for-1, and simultaneously proportionally reduces the par, or stated value per share.
So more shares, but each share has a lower par value. Total par stays the same.
Precisely. There is no change in the total book value of the shares outstanding, and no effect on retained earnings or total shareholders' equity. It's purely cosmetic in terms of total equity, just changing the number of shares and par per share. Only requires a memorandum entry. Reverse stock splits are the opposite. They reduce the number of shares outstanding and proportionally increase the par value per share.
Yeah.
Often done by companies trying to boost their stock price above exchange listing minimums.
So there's a lot of action within equity, whether it's new stock, buybacks, or different kinds of dividends. Where do we see all these changes summarized? It feels like we need a dedicated statement for that, given all these moving parts.
Yeah, absolutely do, and we have one. All these movements are summarized in the Statement of Changes in Shareholders' Equity, sometimes called the Statement of Stockholders' Equity. Purpose. This statement provides specific, detailed information about changes in an entity's primary equity components over a period. This includes capital transactions, like stock issuances or buybacks, distributions to shareholders, like dividends, and critical reconciliations of key equity accounts, like retained earnings and accumulated other comprehensive income.
So it connects the beginning and ending balance sheets for the equity section?
Exactly. It helps you track the flow within the equity section and understand the specific drivers of change in owner's stake during the period. If you refer to the Sydney Technologies, Inc. Statement of Changes in Stockholders' Equity example, you'll see how it's structured. It's a columnar report that tracks the beginning balance of total equity, retained earnings, AOCI and common stock, and API.
Columns for each equity account.
Right. Then it meticulously lists the impact of comprehensive income, which itself is broken down into net income and OCI components, any common stock issued, treasury stock activity, and dividends declared. By summing these changes line by line, column by column, you arrive at the ending balance for each component, reconciling the balances from the start of the period to the end. This statement is incredibly powerful for understanding the detailed movements within the equity section that aren't fully captured by just looking at the balance sheet and income statement in isolation.
This has been an incredible deep dive into the financial story of a company, from its core statements to the nuances of equity. What's one of the most practical metrics derived from all this information that directly impacts shareholders and is widely reported? Feels like we're leading up to EPS.
You read my mind. That brings us to earnings per share, EPS, an incredibly crucial profitability metric. It is required for all public entities and must be presented on the face of the income statement. It provides a per-share measure of a company's profitability, which is essential for investors looking to evaluate the value of their holdings and compare companies.
The famous EPS number.
The famous EPS number.
Right.
How it's presented depends on a company's capital structure, simple capital structure.
Mm-hmm.
If a company only has common stock outstanding or no other securities that can become common stock, like convertible bonds or options, it is a simple capital structure. In this case, only basic EPS is reported, complex capital structure. If a company has securities that could convert into common stock and potentially reduce EPS, making it dilute, it has a complex capital structure. These companies must present both basic EPS and diluted EPS.
Okay, basic and diluted. Let's start with basic.
Let's focus on basic EPS first for a simple capital structure. The basic EPS formula is income available to common shareholders, weighted average, number of common shares outstanding.
Income available to common. How is that different from net income?
Good question. Income available to common shareholders. This is calculated by taking net income, or income from continuing operations, if presented separately, and subtracting preferred dividends. Why? Because preferred shareholders have first claim on earnings up to their dividend amount. This ensures that only the income truly attributable to common shareholders is in the numerator. For cumulative preferred stock, you subtract the dividend requirement whether declared or not. For non-cumulative, you subtract only dividends declared.
Makes sense. Got to pay preferred first. What about the denominator?
Weighted average number of common shares outstanding, WACSO. This is the average number of shares outstanding over the period. taking into account shares sold or reacquired on a time-weighted basis. You can't just use the ending share count, as that wouldn't reflect shares being issued or bought back during the year. It accounts for changes in share count throughout the year, a critical rule for stock dividends and stock splits in WACSO. They are treated as if they occurred at the beginning of the earliest period presented.
Whoa, retroactive adjustment again. Even if the split happened late in the year.
Yes, this means that shares outstanding before the stock dividend or split must be retroactively restated for the current period and any prior periods shown. This ensures comparability across periods. You're comparing apples to apples in terms of share count structure.
It's a huge point for trend analysis.
That's a huge point. Retroactive adjustment for splits is crucial for comparability. Can you give us the essence of how the weighted average number of shares outstanding is computed, especially when splits and reacquires happen? Seems like it could get messy.
Certainly. While the detailed calculation can look complex with multiple transactions, the core idea is simple. Time weighting. You track the number of shares outstanding for each period between changes in share count, like new issuances or treasury stock purchases.
Okay, track the blocks of time. Right, so shares outstanding for the whole year get a weight of 1 or 12 months. If new shares are issued halfway through the year, they're weighted for the portion of the year they're outstanding, for example, 612. Similarly, reacquired treasury shares reduce the outstanding count and are weighted for the time they were not outstanding or negatively weighted for the time they were held as treasury. You sum up all these time-weighted blocks of shares to get the WACSO. The crucial part, as we mentioned, is that stock splits and stock dividends are applied retroactively to all periods presented, adjusting the beginning balance and all intervening transaction amounts as if the split dividend happened at the very beginning.
That's a really clear step-by-step for the idea. So what happens when a company has a complex capital structure? That implies additional securities that could become common stock and mess with the EPS number.
Exactly. When a company has securities that can potentially be converted to common stock, it would therefore reduce EPS, it'd have a complex capital structure. For these companies, both basic EPS and diluted EPS must be presented on the face of the income statement.
Diluted EPS, showing the worst-case scenario if everything converted.
Yeah, that's the idea. The objective of diluted EPS is to measure performance, assuming all potentially dilutive common shares outstanding were converted into common stock. It shows the maximum potential dilution of earnings per share. Potentially dilutive securities include convertible securities, for example, convertible preferred stock, convertible bonds, warrants, and other options, contracts that may be settled in cash or stock, contingent shares, shares that will be issued upon meeting certain future conditions. The diluted EPS formula adjusts both the numerator income and denominator shares of basic EPS. It essentially adds back the income impact of not having those dilutive securities like interest saved on bonds net of tax to the income available to common shareholders and adds the shares that would be issued upon conversion or exercise to the weighted average outstanding share count.
So we have different methods for different dilutive securities. How do options and warrants dilute EPS? That seems less straightforward than convertible bonds.
You're right, it's a bit different. For dilution from options, warrants, and their equivalents, the treasury stock method is used. This method makes a crucial, somewhat counterintuitive assumption.
Okay, what's the assumption?
It assumes that the proceeds a company would receive from the hypothetical exercise of all in-the-money stock options or warrants are then used by the company to repurchase its own treasury shares at the prevailing average market price during the period.
So assume options are exercised, company gets cash, company uses cash to buy back shares.
Precisely. Options and similar instruments are only considered dilutive and included in the calculation if the average market price of the underlying common stock during the period is greater than the exercise price. They have to be in the money. If the exercise price is higher, they are out of the money and would be anti-dilutive, increase EPS if included, so they are excluded. The calculation essentially determines the net number of new shares introduced to the market. Shares assumed is issued upon exercise minus shares assumed repurchased with the proceeds. That net increase in shares is added to the WACSO denominator for diluted EPS.
That's clever, making the assumption about repurchasing shares to find the net impact. What about convertible securities like bonds or preferred stock? How does that work?
For dilution from convertible securities, the if-converted method is used. This method is more direct. It assumes that the convertible securities were converted into common stock at the beginning of the period, or at their issue date, if later.
Assume they converted right away.
Right. For convertible bonds, the calculation involves adding back the interest expense, net of tax, associated with those bonds to the numerator. income available to common shareholders. Why? Because if the bonds were converted to stock, that interest would no longer be paid. In the denominator, you add the common shares that would be issued from the assumed conversion to the WACSO. For convertible preferred stock, the numerator adjustment means you don't subtract the preferred dividends associated with the convertible preferred stock from net income. Why? Because if the preferred shares are assumed to be converted to common, those preferred dividends wouldn't be paid. In the denominator, you add the common shares that would be issued from the assumed conversion to the WACSO.
Now, a critical step. What's the anti-dilution rule? It sounds important to prevent misrepresentation, like making EPS look lower when it wouldn't actually be.
This is very important. You only include potential common shares from options, convertibles, etc. in the diluted EPS calculation if they're actually dilutive, meaning their inclusion reduces EPS compared to basic EPS, or the previously calculated diluted EPS if testing multiple securities.
So if adding them in makes EPS go up, you leave them out.
Correct. If including them increases EPS, they are considered anti-dilutive and must be excluded from the diluted EPS calculation for that period. The test for dilutive or anti-dilutive effects should be based on income from continuing operations. This prevents a company from including securities that would artificially inflate the denominator more than the numerator adjustment, making EPS look lower, more diluted, when in reality these conversions would actually make per-share earnings higher. Companies test each potentially dilutive security individually, usually from most dilutive to least dilutive. The same principles apply to contracts settled in cash or stock. If a contract could be settled in either stock or cash, it's presumed settled in stock if that would be more dilutive. And for contingent shares, shares issued upon meeting conditions, they are included in basic EPS if all conditions are met by period end. For diluted EPS, if conditions aren't met but would be met based on current performance at period end, like hitting an earnings target, they are assumed to be issued if dilutive. Finally, EPS disclosures are extensive. Companies must provide a reconciliation of the numerators and denominators used to calculate both basic and diluted EPS, showing the adjustments made for each dilutive security. They must also disclose the effect of preferred dividends, list any securities that were anti-dilutive and thus excluded from diluted EPS for the period, and describe any significant post-period end transactions affecting shares that occurred before the financial statements were issued.
Wow, a lot of transparency required there to understand how they got the EPS numbers.
Yes, that level of transparency is key for users to fully understand a company's per-share profitability and the potential impact of its capital structure.
So whether you're looking at a basic or complex company structure, EPS gives you that crucial per-share view of profitability with careful rules to ensure it accurately reflects potential dilution. This metric is truly a cornerstone for any investor. Hashtag tag tag outro. Phew. We just covered a massive amount of ground, from the fundamentals of the balance sheet and income statement to the nuances of discontinued operations, foreign currency, comprehensive income, and even the nitty-gritty of how earnings per share are calculated.
We really did. We've unpacked the crucial terminology, walked through some illuminating, detailed examples, and hopefully given you that aha moment that connects these seemingly disparate pieces of information into a coherent financial narrative.
Yeah.
Remember, financial statements aren't just numbers. They tell the story of a company's past, present, and potential future, revealing its health, its operations, and its strategy.
And what does this all mean for you, our amazing listener? It means you now have the tools to look beyond the headlines, to truly understand the underlying health and strategic direction of a company, whether you're a prospective investor, a curious employee, or just someone who loves being truly well-informed. You have the power to analyze what's actually happening, not just what's being reported at the surface.
Right. And this raises an important question for your continued exploration. How might a seemingly small change in an accounting assumption, maybe how they estimate bad debts, or a reclassification adjustment that we now know how to spot, like moving something into discontinued operations, how might that actually signal a significant shift in a company's financial health or strategic priorities?
That's a great point. It's not just the final number, but how they got there.
Exactly. It's about connecting those dots to the bigger picture, moving from simply reading the numbers to understanding the profound implications they carry. What story are the choices behind the numbers telling you?
That's it for this deep dive. Thank you for joining us on this enlightening journey. We hope you feel empowered and ready to tackle your next big challenge with confidence. Until next time, keep digging, keep learning, and stay well informed.